Good afternoon, everyone. We're going to wait a couple minutes to try and start promptly at 4 to be respectful of everyone's time. Just letting everyone log in now.
How's the weather down there, by the way?
Supposed to get rain tomorrow and Thursday, but it's been pretty good.
Yeah, we just got clobbered with some really bad rain over here. Looked
The
outside.
hurricane?
It was nice and sunny up until about an hour ago.
No, the other day we actually had like some September weather. It was like 72. Wasn't too hot. It was actually really nice.
Oh yeah, last week it was like that too here. At night it actually gets pretty cool because we're so high up in the mountains that
Mhm.
it's a nice. It always feels like a nice September fall. It's not that hot, not that cold. It's perfect.
Well, I think on that note, it's 4 o'clock. To be respectful of all the attendees' time, why don't we get started? Good afternoon, everyone, and welcome back to our estate planning webinar series. We're thrilled to have you join us for part 3, where we continue exploring the strategies, tools, and updates that can help you protect your legacy and plan for your future with confidence. At the Legacy Group, sorry, I'm trying to do 2 things at once, and I apologize about that. My apologies, my screen just went on. Make sure I said perfect. At the Legacy Group, our mission is simple yet powerful. Help individuals, families, and business owners build and preserve wealth across generations. We do this through our signature 3-dimensional planning approach, which integrates financial, legal, and accounting perspectives into one cohesive strategy. This collaborative process allows us to uncover gaps, identify opportunities, and create a plan that supports your long-term vision with clarity and confidence. Before we dive in, I want to take some time to introduce our speakers today. Jeff Velastegui is the founder and managing partner at the Legacy Group. He is a seasoned financial planner with a deep background in tax-efficient planning and wealth preservation. He specializes in helping high net worth families navigate complex planning scenarios with clarity and precision. Evan Rodakis is our director of financial planning at the Legacy Group. He specializes in estate planning, gift planning, and business succession planning. For those of you who joined us for part 2, you'll remember we built on the foundation laid down in webinar 1, covering the basics of estate planning, key documents, and common misconceptions. And we took a deeper dive into, sorry, I'm getting messages. Deeper dive into advanced planning strategies, including how recent legislative changes may impact your estate, your business, and your beneficiaries. Today, we are going to focus on key planning strategies for business owners. As entrepreneurs and business leaders, your assets and succession plans require careful consideration to ensure your future stability and your family's security. In this session, we will cover key planning considerations tailored for business owners to effectively plan their estates. Whether you're seeking to protect your assets, ensure smooth succession, or minimize taxes, this session will provide valuable insights to help you create a comprehensive estate plan that aligns with your personal and business goals. As always, we want to make this session as interactive as possible. Please feel free to drop your questions or comments in the chat at any time. We'll be monitoring throughout the session and we'll address as many as we can during the Q&A portions. With that being said, Evan, I'd like to hand it over to you at this point. If you could give everyone a quick rundown on the topics that we went over for webinar 2. The floor is yours.
Fantastic. First thing that was take away was the changes that recently happened for estate tax laws. In 2026, that number will go to $15 million as the exemption amount federally. I know we have people from all across the country, so the state by state legislation is important to understand. If you have any questions about your particular state's laws, we can reach out to Jeff and talk about it then. To plan for those estate taxes, we try to leverage annual exclusion gifting and larger gifts. Just as a reminder, we can do $19,000 per year per donee. That number used to be 10 a long time ago, and sometimes that's why you hear that number all the time. It increases with inflation and it moves up on the 1,000. Along with those annual gifts, there's certain gifting techniques that you can use to leverage that gift. And they have tons of acronyms: SLATs, ILITs, GRATs, IDITs. It goes on and on with estate planning, and they're all confusing acronyms. But what we do is try to simplify those scenarios just to reduce the amount of the federal estate tax that might be owed. And the last takeaway that we had from last week, or a couple weeks ago, I guess, was if you find yourself in that scenario where you are a high net worth family that may have an estate tax, putting your head in the sand is just not an option. And proactive planning is the best thing you can do to save money on estate taxes.
Thank you so much, Evan. What we're going to do now is transition into the topic we have at hand today, which is proper planning and our philosophy on how business owners should work to ensure that their legacy is kept the way they want. Jeff, if I can pass it over to you.
Sure. And good afternoon, and thank you for everyone for joining us. The topic of business owners, right? It's so broad. Having done this for almost 24 years, it never amazes me how business owners are all very similar in not necessarily in what they do, but how they manage their personal life and their business life. And a lot of times what I see and what we see at the Legacy Group is really unintentional consequence of not planning, right? So when we work with business owners, and really our philosophy behind all planning, not just for business owners, is that it should be collaborative, right? And collaborative, what I mean by that is a collaboration has to exist between, your advisors, right? Your legal team, your accounting team, your tax team, investments and planning, because the more you grow, the more your business grows, the bigger the problems. The more money you make, the bigger tax bill, right? So you have to get very creative and collaborative in how you approach these things. So when working with business owners, we want to make sure that the business is part of your life and not a separate entity. And even though it is, a lot of people don't look at them as such, and there's a disconnect between what they want for the business and what they want for their personal life. So, working with business owners, that is the one thing that we do look for, is how do we integrate both the business and the personal planning. We accomplish this by helping people make decisions on a daily basis, right? And we're very deliberate around whether your goal is reinvesting to grow, whether your goal is to reduce the risk, or even transitioning your ownership to the next generation. Every person we meet, every business owner we meet, they're all at different stages. The circumstances are slightly the same, but at the end of the day, the solutions are very similar in all, right? So again, understanding your intent, where you are in life, what you have done to this point to achieve, your current planning, we pick up from where you left off. And a lot of times we find people have done zero planning, right? And we'll get into the reasons why that's not a good idea either. And we also understand that when you are just a business owner that just started 3 or 4 years ago, your main objective is, how do I make money? How do I keep this thing afloat? And how do we become profitable, right? But as that happens, I think that people often forget how important it is to incorporate all the planning that has to be done as your business begins to grow. So, Rob, can you hit the next slide? So actually, no, you're just fine. I'm the one that's behind. Go back one slide. I'm sorry. Go back. You were on the right slide. That one right there. So, again, we aim, the aim is to pass ownership, right? So when we talk with our business owners, we look to collaborate with the legal professionals, the financial professionals, to develop these strategies to achieve the most optimal transition. We preserve the business valuation and operational continuity to make sure that we have that succession plan in place. Taxes are a big part of what we do, right? Decisions that you make today are going to have a huge impact tomorrow. But I will tell you, today you have more options than you have tomorrow in any given day. Whether you're in the construction business, the restaurant business, whether you're in pharmaceutical sales, doesn't really matter. Really for us, I think that what's important for people to recognize out of today's meeting and today's webinar is that, there are things that you need to be intentional around planning. So, that's what I'll say around the philosophy and what we're hoping to achieve when we collaborate with your other advisors and working together with them. Go ahead, Rob.
Thanks, Jeff. I think what you said was so important that, the people with us today are business owners, and they've worked hard and strive to build something that is successful. And in most cases, it's the lifebone behind their entire, their family and their family's wealth. One of the things we're going to focus on today is how do we plan properly to make sure that that business follows lineage, or that business is transitioned to the next ownership group, whether that be in the family to an employee or being sold, whether again it's by choice or by passing. What we're going to do now is pass it back to Jeff, and Jeff's going to go over some key strategies and ideas with regards to business succession planning.
So yeah, succession planning, like I said, it's another thing. It's one of the key things that we talk about very often with a lot of our clients. And when we meet them, it doesn't necessarily mean that they're all ready to, for a succession plan. But what I said just a little while ago, right? Today you have more options than you'll have tomorrow. The worst succession plans are the ones when people come to us and say to us, "Hey, I'm 60 years old and I'm ready to retire, and I want to retire in the next 5 to 7 years, and this is my situation, right?" And I think, can it be done? Yes, depending on how you've built your business, right? And I think what's important to recognize is are you the sole reason why the business operates and is successful, right? And those are a question you have to always ask yourself. And I ask the clients the tough questions, right? Or is the business able to run without you, right? Because depending on how that that is answered, it tells us how marketable is this business if we're looking to sell it, or how able is the existing team, right, that you have people, your employees, or partners, right, running the business, and are they able to continue the business in your absence? Because the question I always ask my clients is, is a business prepared for a fallout, right? Meaning, what happens if the owner dies or gets disabled, or one of the partners wants to exit unexpectedly, right? These are things that you have to ask yourself today, and how are we able to get through these all of these challenges, right? Because these are challenges that all businesses go through at some point or another. And a huge part of that, right? Having a business that has a good continuity plan also plays along with preserving family wealth. A lot of times, the biggest asset that our clients have is their business, and in the absence of a continuity plan or a succession plan, a lot of wealth could be lost as a result of not intentionally planning around that. Reducing legal and tax complications. I mean, look, present company excluded Evan. I know he's an attorney at hand, but I don't really like attorneys for the most part, because they, they're the ones that win when there's an absence of a plan, right? And that's what we're here for, right? That's why Evan's one of the good guys. He's on our team, right? He works with us, and he helps protect, and uncover all those unanswered questions when we talk about legacy planning and succession and why it matters so much for our clients. So I'll leave that. Can you just go to the next slide, Rob? Because in the next slide, we really talk about all the key considerations. It's a busy slide. I don't want to, I'll hit the key points on it. But what I'll tell you, timing is always the key. And people will say, look, the timing is not always right, but you always have more options today than you will have tomorrow. I think that's the third time I have said that. And the reason I keep saying it over and over, because more times than not, when we meet with people, there are 20, 30 years into their business, and they're just now starting to think about a succession plan, it does make things a little bit more difficult, right? And I love it when I meet with a younger business owner in their, mid 40s to early 50s, right? Because they're not thinking, hey, I'm retiring in 15 to 20 years, or a lot of them aren't. But at least we have an opportunity to build a succession plan along. And sometimes that succession plan is not always selling the business. Not a lot of people have the ability to say, hey, look, let's go to private equity and sell this for 20, 30, 40, $50 million. Sometimes we're talking about smaller business owners that have to be very intentional about developing and building future leaders, right? I love talking about this book called Who, Not How, because it really transformed the way that I look at business, and how my most successful clients, how they've been able to build wealth, right? And in the concept of Who, Not How, by a book by this guy, Dan Sullivan, who's a coach that I hired a long time ago, it really is a very simple thing, right? Who can help me achieve that goal, right? And for a lot of times, for the really successful business owners, are the guys who are not really involved in running the day-to-day. They found people to do that for them, probably better than they can do it themselves, right? For that, we're talking about a business that's profitable, a business that's growing, a business that is thriving, right? And having done this for almost 24 years with business owners, I will tell you there aren't that many businesses that can go from first generation to second generation, third, or even a fourth one. And we're fortunate enough to actually have clients that are 3 generations, 4 generations in. And I can tell you, those are the people that have focused their time in developing and building future leaders. Critical things to consider: never forget about keeping an updated business valuation. Business valuation is important because obviously when you have family members as partners, or even if they're not family members, you always want to have a document that clearly dictates what the business is worth, right? Today it might be worth, $2 to $3 million, but tomorrow it might be worth $5-10 million. And you have to have something that says, this is where, this is how we achieve a valuation. In the absence of that, guess who wins? The attorneys again. So you don't want to get into a legal battle with partners or family members because there aren't, that valuation done on a frequent basis. Legal documents. Your legal documents are important, right? We'll talk about buy-sell agreements here in a minute. We'll hand it over to back to Evan in a few minutes. But legal documents must be kept up to date, right? Every couple of years. If you're updating the valuation, you should be updating the buy-sell agreement. And that what I mean by updating doesn't necessarily mean, hey, you're rewriting this thing, but at least review it. Have an intentional conversation with your attorney. Have an intentional conversation with your attorney, your tax advisor, or your financial planners, and say, look, has anything changed, right? And in the absence of that, that's when you get into these situations where, oh, I didn't know that's how it works, right? And then the last piece of it, I would say, look, it's the tax planning. The tax planning, if you have an idea of what your situation is or what you want it to be, it's always better to talk about it today with your accountant, your CPA, your financial planners, to help you find the most suitable transition plan in succession planning altogether. So out of that slide, those are the key dynamic points to consider as you're going through this planning stage of life. So Evan, can you just take us through what it means in terms of guarding our legacy and the critical role it takes
Sure.
in the buy-sell agreement world?
So the answer to the test, to the overlarge question of how do we plan for it? We talked about all the bad stuff that happened. It's called a buy-sell agreement. It's basically a will or a prenuptial agreement for a business. It tells what's going to happen at different scenarios and what we're going to do when that occurs. Legal contract, it's between 2 partners at the time that they're sitting down at the table. Usually what'll happen is client will say, hey, no, don't worry about it. We got it done already. Most business formation agreements do not address the possibility of a breakup. It'll have a section that might say dissolution, and it just says, hey, we walk away even. That's not the same as if Rob and I own a business together and Rob's now disabled. How long am I going to pay his salary? At what point do we trigger a sale? If Rob passes away, do I own that business with Rob's wife, who's very, very nice? However, I don't want to own a business with her. Or vice versa. Does he now own it with my wife, Jen? Which could also be a disaster, will be a disaster. And so a buy-sell addresses those issues in anticipation. So Jeff has mentioned a couple of times, when you have the time to do it, that's the time that we negotiate and say, what's the price, the valuation that came out of it? What occurs when someone passes away? Am I buying it out in one chunk? Do I have the cash flow for it? All of that happens within the buy-sell agreement. Today, my main focus is going to be death because it's finite, but know that there are other avenues that can be addressed: departure, divorce. What happens if Rob and his wife don't work out, and all of a sudden she's trying to take a piece of those shares or those units, depending on how the business is incorporated or how it's formed. And so we try to address those in advance. Maybe Rob can't handle his finances and it's bankruptcy. Well, now I have a bankruptcy judge trying to put a charging order on my business. If I had an agreement prior to that, I'm able to at least say, if you go into bankruptcy, partner Rob, that triggers. That's an offer to sell me those shares or sell the business those shares. So if we go to the next slide, I just want to go into there's two main types. And there's gradations, but these are the two extremes. The first one is known as a cross purchase plan, and the second one is a stock redemption or entity purchase plan. And we're going to explain what happens. Again, I'm going to focus in on death because it's finite, but it doesn't have to be death. It could be disability, departure, etc., bankruptcy. So let's go to the next slide there, Rob. So cross purchase. What ends up happening is that, let's say Rob passes away. I'm going to keep killing Rob off. I'm sorry about that, buddy. He passes away, and then I purchase. As the other shareholder, partner, member, doesn't, again, depends on how your entity is formed. Shareholders are, corporations are shareholders, partnerships are partners, and LLC are members, but they're all basically the same thing. So I would then reach out to Rob's wife and say, hey, Rob passed away. I have a contract that says I'm going to buy those shares from the estate. She gets nominated as executrix or executor, and then she will sell me those. I wake up the next day and I have two sets of shares, 50% when I started the business with Rob in our garage, and then the other 50 shares I have now purchased from Rob's estate at an increased basis, which I think might be a little beyond the scope of this, depending if we have time at the end and go into that. The next major type would be known as an entity purchase or stock redemption. And what happens in this case is that the business buys the shares. The entity reaches out to, again, Rob's wife, says, hey, Rob passed away. We are going to redeem, or the entity is going to purchase those units or shares. And it might seem, depending on I know we have a lot of people here today, but it might seem like that I'm splitting hairs, but it's really not. It's easy when the example is just Rob and I, and we say, all right, I'll buy it, or the company that I'm still running is buying it. However, what if there's 4 or 5 partners or owners, or if you're in a law firm with 12 different partners, or 15 different accountants together? It doesn't matter the business, but the more owners that there are, the more complicated it gets, and which one we choose matters that much more. There's other tax reasons. Yeah, if you reach out to Jeff or Rob or Pam, we can easily send over. There's a matrix that we have that says pros and cons of both, but they both have their place depending on the organization of the business and the goals of that client. I think we can go on, Rob. There we go. So Jeff, I'm going to hand this off. This is a recent case that Jeff's going to talk about. You're on mute though, Jeff.
All right. So yes, Connolly versus the United States. This is actually something that's very current. And what I mean by very current, June of 2024. This is a live case a real life case that by the name of Connolly versus the United States. Basically, the situation was simple, right? 2 brothers owned a business together. They had a buy-sell agreement, very similar to the one that Evan just described, entity purchase, which basically said that if one of the brothers died, the life insurance owned by the company was going to be used to buy the shares of the deceased partner, right? The tax question, right? So there's two sides to every story, right? Because up until June of 2024, this had never been questioned before, right? So the IRS is the one that said, hey, wait a minute, we don't agree with how the ownership structure of the life insurance, right? Because what the estate is arguing is saying that the company's valuation shouldn't have increased because of the life insurance money that was received upon the death of the partner. But the IRS said that because the life insurance proceeds were owned and paid and controlled by the company, that the proceeds would have increased the value of the of a company. So if you look at the diagram on the right-hand side, right, you know, the initial valuation of the company was $3.8 million. They issued a $3 million policy on the life of the partners. So the new valuation of the company was $6.8 million, right? Michael, the deceased brother, right, his share went up, you know, significantly. And what that means is at the end of the day, they are actually paying more estate taxes as a result of how, or as a result of the insurance inflating the valuation of the company. Now, why am I telling you about this? And I'll let Evan get into the nitty-gritty details. But in essence, this is a conversation I was having with a business owner, right, who owns a bunch of restaurants. And at the end of the day, he had this very problem, right, where we have multiple partners, a bunch of entities, and we have the wrong type of agreement, right? So in this situation, we have to get really creative in how to react to the recent change in the law, right? I'll let Evan tell you a little bit more around kind of how we fixed the issue for the clients, and how we're implementing a viable solution to make sure that we're avoiding an increased tax unnecessarily because the IRS decided to move the goalposts, right? Not that the planners or not that the attorneys did anything wrong, right? But rather that they changed the mind of how this is viewed in the eyes of the IRS. And unfortunately, this was already contested, but ultimately went all the way up to the Supreme Court, and they ruled in favor of the IRS. So these are the kinds of things that we uncover as a result of asking questions and really getting into the nitty-gritty of the planning with our clients. So Evan, can you just chime in and let us know a little more about Connolly here?
It was very, very exciting in my life because my cases never hit the Supreme Court, almost never. You don't find a lot of estate or business succession planning cases that hit the Supreme Court, kind of settled law. This really upended everything. So everything I talked about previous to this slide matters to anyone, regardless of the size of the business. It's just planning for death, disability, someone wants out of the business, bankruptcy, divorce. That's for everyone. Connolly is very, very pinpointed to a specific individual. It is an individual that is worth north of those estate tax limits we were speaking about. Okay, so in the previous meetings we had, we talked about that number, that federal tax number. It's about 15 million. So we're talking about being north of there or being close enough that when your business receives a boatload of insurance to buy out a partner, that's a technical term, that it doesn't push you above those limits. So the key takeaway to talk to your financial professional, insurance professional, someone, your accountant, about is if you are worth a few $1 million, $4 or $5 million of outside assets, and you might even have a buy sell, or your business with insurance puts you closer to those 8 digits at 10 to 12 to $13 million. That is when alarm bells should be going off. The moment we get off, you should be emailing Jeff and Rob because this is a problem. Not every professional knows about it. It really is whether your attorneys and CPAs generally work with high net worth individuals. We have plenty of reading on it. Jeff wrote a great article that was published. It can be sent out. It's just, it really, right now it's a trigger. I think it's bad law, meaning that I think the Supreme Court got it wrong on this one, but it doesn't matter because it's the law and we now have to deal with it until it's reversed. So again, Connolly, the main takeaway is you have a business that's worth a good amount of money by anyone's standards, and you have assets outside of that business. Those are the two main. If you have those two things, Connolly might affect you very, very negatively.
And I'll just piggyback with what you're saying, Evan. I'm sorry just to bump back in, but I'll tell you I think you said something that's very, very good, and I think I want to say it again, right? And that's the fact that not everyone is running into these issues, and I'll tell you why they're not running into it. Most of you, right, who are business owners who are on this call, from New York all the way to California, and I appreciate and just want to give a shout out to all the people that are joining us from all over across the country, which is actually pretty cool. But I will tell you, Evan did say two things that are number one is if you have assets, personal assets in that 5 to 6 million, $10 million range, and then you have a business aside from that with life insurance, right? Just add the numbers, right? Even though the state tax thresholds, are changing for the better, right? In 2026, we're only still talking about a $15 million number, right? After $15 million, everything's going to get taxed from a federal level at 40%, right? So that's the tax that you have to be questioning, right? That's the question. The question you should be asking is, am I pushing up against that threshold? And for some of you, the answer is unequivocally yes, right? The second question you might be asking yourself, and referring back to what Evan said, not a lot of people, not a lot of attorneys are calling their clients that say, hey, that buy-sell agreement when I wrote for you 3 years ago, 5 years ago, 10 years ago, they're not intentionally calling you back, right? Because at the end of the day, it's still sort of their back. You're the one that has the problem, you, the business owner, and they're the ones that are going to bill you intensively, right, to fix that problem when there is a problem, right? So that's the intentional, proactive approach that we take, is that, look, if there's a problem, let's find it, right, and let's get ahead of it, right? Because, like I said, I go back to having more options today than you'll have tomorrow. So I'll say that to move on to the next slide, I think, which I think it's.
No, I think it's a good transition now, as we talked about how important it is to get your affairs in order. And as we talk about these estate tax limits, why having a proper business valuation is so important.
Yeah, and again, we talked about it briefly. Valuations are, we talk about valuations very often, especially for those clients that are, in that process of retiring, selling their business, or working out some sort of a transition or succession plan, right? So fair market value versus strategic value, right? Fair market value is obviously what someone's willing to pay you for your business, right? You might think that the business is worth 10 million, but at the end of the day, if you can't find someone who's going to pay you $10 million for the business, then it's not worth $10 million, right? And we have had situations with clients that digging their heels about exiting their exit strategy, right? They want to sell, but they have a number that, okay, we put the business in the marketplace, and if other buyers aren't seeing that value, right, you have to be more intentional about, listening to the marketplace. What is the market telling you about what your business is worth, right? And that's why it's important to make sure you have independent appraisals, right? Because there's a lot of ways to achieve a valuation. You can look at your tax returns. You can do, some quick calculations, book value valuations, or 3 times your profit. I mean, depending on the industry you're in. But I would tell you, there are independent appraisal companies that will charge you, right, to really look at what the actual business is worth for your industry. They'll give you a range between, what you should expect to pay. And why these things are important, right, is because there's different times where you want a high valuation, and there are times where you want a lower valuation. I'll give you an example of that, and I'll let Evan chime in as well. I'll give you an example when you want a lower valuation. When you're talking about gifting, right, especially if you're gifting assets to a trust or to a family member, right, you certainly want a valuation that's going to, be lower than if you were to sell the business to a competitor. Obviously, you want top dollar, right? So again, depending on what you're doing, a business valuation is always going to be important, and it's going to play a pretty good role, right? Because the other thing is, you can't say something is worth $1, because guess who's going to have a problem, right? The IRS is going to have a problem if you say, hey, my business is generating me, $2 million in profit a year. It's worth 500,000. That's just not going to fly either. So, Evan, I don't know if you want to chime in and add anything else on top of that.
The valuation, the only other thing I would love to add is that if you are one of the people that have great advisors and have this done already, big problem I often see is that the valuation was correct at the time of the drafting. So you're sitting there, these guys tell me some great information, but I have this stuff done. I know I have it done. You need a review, because if it says that upon Rob's passing, I'm going to buy the business for $1 million, but it's really worth 5 now, we're in a lawsuit just immediately. It's Rob's a widow saying to me, that's not what the business is worth, and it's me saying I have a contract. I'm sorry. and now we're in the fight, and we're spending money on those damn attorneys again. And so we're trying to avoid that. So business valuation, it's not only is important for the initial aspect, it's also really keeping on top of it throughout the years. It's just not a once and done. That would be the only thing I'd have to add. Everything else you said was perfect.
So Evan, at this
Oh,
point,
thank you.
everyone that's on the call has listened to everything you and Jeff have said. They've implemented the proper buy-sell agreement. They've had their advisors draw it up perfectly. They have a correct evaluation. Everything's perfect. So now that that's done, can you tell me some ways that we can go about funding that buy-sell so that if anything triggered it, we're able to transition the way we were planning?
Perfect. So there are a number of different ways that you can fund it. Death is easy. It's finite. It's understandable by everyone. It's life insurance. It says that if Rob passes, either me or the business will receive dollars that will then buy those units or shares from Rob's widow, from Rob's wife. Simple way to do it. Usually cheap, effective, easy, but it's not always the way that it can be done. Maybe Rob's uninsurable because he's unhealthy. So you always have to think about other ways to fund them. First one could be installment payments. Rob, something happens to you. I'm going to pay you out I'm going to pay out you or your spouse over a number of years. Often when we review the docs, we try to tie it to the annual income anyway, so it's not really affecting the business. So if Rob was making $100,000 a year, you create a note that says, all right, instead of me having to pay Rob for $100,000 a year, I will at least be able to I can structure the note in a way that I'm just paying the spouse off of those units. Another one would be internal reserves, just like anyone else that has an emergency fund. And if you don't have one of those, definitely need to call the group to talk. But an emergency fund, it could easily be cash in the business. Of course, when you use your own cash, that might affect other opportunities of growth and building later on. And there's always third-party financing. I owe Rob's family $1 million. I can go next door to Chase and ask them for a loan. An SBA loan sometimes works as well, depending on the size of the business, but I can always go to a third-party option. So it doesn't have to be insurance. But you do see it a lot because it's a cost-effective way of funding these types of agreements.
Jeff, we're going to pass it back to you for some parting words.
Yeah. So again, I think for the most of you that I think there's a good amount of people here that have joined us for the last three. The message is always the same, right? If you have any questions, I'm sure you guys have good people working for you, advisors. We do these sessions with the one hope to help educate people, expand your awareness around what planning is good planning to be done, and really just to get you to ask questions, right? I think the most informed client is the best client, is what we like to do. I mean, we like to say. As we've said in the past, our process is always the same when working with new people, right? We always love to ask questions, get to know you, get to know your specific circumstance, and how can we help you, right? At the end of the day, it's not about us. We always put in a lot of effort, and that's kind of falls into our service first philosophy. We deliver a lot of value before we can even determine whether we're the right people to help you, because we only take a limited number of clients each year. We want to make sure it's a good fit, right? So we are very intentional about making sure to ask the right questions to make sure that we're helping achieve your all of your planning objectives. So once again, thank you guys for joining us, and we look forward to our last session that will be in a couple of weeks. I think you'll be getting an email at some point in the next week or so.
Yeah, just to piggyback, everyone, please keep an eye out. We will be sending you an email about part 4, which is planning in action. And that's where we take the topics of all the first 3 webinars, and we show you a case study of a client that we've worked with, what we implemented, and what the actual impact of that planning was for the client and for their family. So again, we look forward to seeing you at our next webinar, and thank you again for attending.